Today might be the start of a pretty volatile week on Wall Street. We'll get key readings on the U.S. labor market, also testimony, 2 days of it, from the Federal Reserve Chair, Jerome Powell. The Fed will announce its decision on interest rates a little bit later this month. This, of course, follows 8 consecutive rate hikes going back to March of last year. Also, over the weekend, notably, Federal Reserve President Mary Daly of the San Francisco Fed said in a speech this weekend, quote, "It's clear there is more work to do," suggesting that the Fed will need to raise rates higher than expected and keep them higher for longer. But what does it mean for you? Former Treasury Secretary Larry Summers joins us now, someone who has been spot on when it comes to the risks and inflation for a number of years now, warning the Biden administration and others of what is to come. So, Secretary Summers, thanks very much for your time. It wasn't just Mary Daly of the San Francisco Fed. It's also the Minneapolis Federal Reserve President Neel Kashkari, who we've had in the program, Atlanta Fed Chief Raphael Bostic. A lot of warnings, including the warning from Fed Governor Christopher Waller. Do you think the Fed is going to need to increase interest rates more than expected? Maybe it's 50 basis points at the next meeting this month?
Look, I don't think there's any question, Poppy, that we do not yet have inflation on a secure glide path anywhere near down to the 2% level. And until the Fed can be confident of that, it's going to have to be tightening rather than easing. So my guess is that rates are going to reach a higher level than the market is now expecting, that it's going to certainly reach a much higher level than the Fed was expecting last December, and that once again, the data will record that the Fed underestimated inflation and underestimated how much policy was going to be necessary. That's a risky thing because historically we don't tend to be able to engineer soft landings from significant inflation. And so my guess is that at some point the Fed will push and push. We will not get inflation accelerate and skyrocket out of control. But my guess is that the process of bringing down inflation will bring on a recession at some stage, as it almost always has in the past.
How much higher, Larry? I mean, are we talking 6%? Look what Goldman's saying right now.
I wouldn't be amazed if we had 6%. 6% would probably not be my best guess. My best guess would probably be 5.5 or a little above 5.5. But 6% would not surprise me greatly. And I think anybody who thinks that that's off the radar screen is making a real mistake, given all the uncertainties that we have in our economy right now. And I think what people have to do is just be prepared for a lot of things. And the old advice, hope for the best, but plan for the worst, I think is the right advice for your listeners. I think it's the right advice for companies. I think it's the right advice for policymakers.
You know, like you, JP Morgan CEO Jamie Dimon has also been warning about what's ahead, especially when people deplete all that COVID stimulus savings. Listen to what he said. This was on February 23rd on CNBC.
The U.S. economy, this is the contradiction here.
Okay.
The U.S. economy right now is doing quite well. Consumers have a lot of money. They're spending it. Jobs are plentiful. That's today. Out in front of us, there's some scary stuff. And you and I know there's always uncertainty.
Right.
That's a normal thing.
Okay.
This uncertainty is a little bit more than that.
Do you agree with him? This uncertainty is more than normal, and there is some, quote, scary stuff ahead. And if you do agree, what does that feel like for the average American?
Poppy, I've used the term risk of a Wile E. Coyote moment to refer to the fact that the economy could hit an air pocket in a few months. My guess is that the overhang, the savings that consumers have accumulated has a few more months to run, but it doesn't have another year to run. Businesses seem to be long on inventories. Right now, businesses are holding on to workers because there's been a labor shortage for the last couple of years. But if that starts to go away, then they're going to feel less pressure to hold on to workers. It may be that interest rates are going to eventually work their way through the system, and that's going to have a significant effect on employment, for example, building houses. So you've got a variety of dynamics that could kick in. I thought it was interesting in a survey of households, they said they were feeling really quite good now, and they were worried about the future. And when you ask some of the big retail companies when they reported their earnings, like Walmart, they said something quite similar. So I think between the risk of inflation and the risk of some kind of air pocket, the Fed is trying to walk along a very, very narrow ledge, and it's not an easy situation.
Yeah, it's a tightrope. There's no question about that. Larry Summers, thank you, and we'll see what members of the Senate and the House ask Fed Chair Jay Powell when he testifies this week. Appreciate your time this morning. Our chief business correspondent, Christine Roman's here to break it down.
They're calling it Hell Week on Wall Street this week because there's so much happening and it's all really important. You've got Chair Powell going to the Hill for a couple of days. You've got a bunch of different job statistics until we get to Friday's jobs report. You've got the president's going to drop his budget blueprint on Thursday. So there's a lot that matters for your money happening this week. And one of the big issues here, I think, is a very strong job market. And that is something that has been a problem for the Fed. We're expecting the job market to be maybe 200,000 jobs added in the most recent month. And you can see, remember last month, how strong that number was? So the job market continues to be very, very strong. And we expect we're going to see that again this week.
So why would a strong labor market be bad news for the Fed?
It's because the Fed has been raising interest rates over and over and over again, and it's not cooling off the job market. And that strong job market could continue to spin off more inflation. And the Fed is trying to cool inflation. So it just shows you the Fed might have to keep interest rates higher for longer. We know that there are two jobs open for every person who is looking for work. That is a really, really tight labor market. That chart right there shows you that the Fed might still have a lot of work to do. The Fed would like to see things cool off a bit. So we have a strong job market. It's great for Main Street, not so great for Wall Street.
Well, and also it really kind of shows you the power or lack of the Federal Reserve when it comes to these interest rates. Because if they're not impacting the job market, are they having any impact?
And I think that's what you're going to see the Fed chief grilled about this week. You're going to hear him. People on the Hill are going to say, you're going too hard. This is hurting working families. Or they're going to say, you're not going hard enough getting inflation under control. So I think he's going to be criticized on both sides. But we can see where the Fed interest rates have been working. In the housing market, that has slowed, but also credit card interest rates. And I think this is really the takeaway for kitchen table economics here. Credit card interest rates are at record highs. 19% for a typical credit card, up to 30% for a store card. If you put $2,000 on a typical credit card, you only pay the minimum balance. At 19%, it would take more than 12 years to pay it off, and you would have $3,200 in interest on that $2,000. That is just... Wow. That is just
more interest than the initial
Way
spend.
more interest than the initial spend. And on a store card, it's even worse. So I think that where you're seeing the higher interest rates really working through the economy are places like that, and that's where people have to really be careful on.
I think Caitlin makes the point, which is the medicine's not working enough. The Fed medicine on interest rates is not working.
So what does that mean?
Yet.
Does the Fed have to keep
what
raising interest rates? Do they raise it to 5%, the target rate? Do they raise it, as Goldman Sachs suggested, closer to 6%? That means higher rates for longer in the economy. And higher rates are something...
We don't even know if it would work.
Right. Well, higher rates are something that real people and working families feel. Meanwhile, the job market is strong, right? On its surface, that should be good news. The job market's strong. There are a lot of jobs open for people out there, even with these headlines in tech and in finance of layoffs. Overall, the job market's strong, and you still have very few layoffs every week.
Okay. Confusing economy as always. Hell Week. Brace
Busy week.
yourselves. Thank you, Romans, very, very much.